Ladies and gentlemen, Tobin Smith here. It's time for Money Mavericks. By the way, we always like to start off these shows with a real maverick, and we have one. His name is Jay Hatfield. Full disclosure, I have known Jay, for 15 years probably. I first met him when he was managing his MLP fund, Master Limited Partnership Fund, called AMSA, and I remember very closely, Jay, during the wipeout in April of 2020 into the pandemic, sadly the pandemic, that since these MLPs were mostly owned by retail investors who were scared crapless is the nice way to put it, the fund went from like $12 down to $4 in like 2 days. I know that you've redone your hair color because of that, but we have 4,000 subscribers jumped in and bought AMSA. And you guys successfully, rejiggered it, got it going. And now I just talked to a couple of our money management clients, and I said, I'm going to have Jay Hatfield. They say, well, tell Jay we love him. Tell him that between the reinvestment of the huge dividend we were getting at $4 cost basis, I can't even, if I said it was a 28% yield, people would, laugh, but it was. And so anyway, they reinvested their dividends. And one of our accounts has a negative $6 basis in AMSA.
That's good. That's a good reason to not sell it.
That is a really good reason not to sell it. And then the other side is your preferred shares. So tell the audience a little bit about your company and what the funds you do, because then we're going to get into his opinions. And ladies and gentlemen, Jay Hatfield has no opinions whatsoever, particularly about inflation and the Fed. So we had to have him on Fed Day. So Jay, give us a quick look.
So we have 5 funds. You mentioned AMSA. It's one of our larger funds. MLPs yields about 8. We do look at the dividend for our Virtus funds every January. So stay tuned for that because rates are coming down. We do borrow money. So we're optimistic about that dividend. PFFA you mentioned. We're also, Virtus is our partner on that fund. So we're optimistic also about the dividend there.
Sure.
PFFR is an index fund, so we really can't add value to the index. So it's like most fixed income, you're going to see more stable dividends. And then ICAP.
It has a little less volatility because it's not leveraged.
Correct, yes.
Yeah, okay.
And SCAP and ICAP, small cap dividend fund, yields about 6. Large cap dividend fund is ICAP. Both those funds are our partners, U.S. Bancorp. We look at the dividend every quarter. And you'll see we've been raising those dividends, and that's likely to continue. So all of our funds yield 6 to 9%. All have done extremely well this year.
Oh, yeah.
But we expect them to do well next year. And when we talk about macro, we can talk about why we think they're.
All right. Well, we just get done with a Fed meeting, and the Fed chairman was pretty. My favorite part of the whole thing was when they said, if President-elect Trump wanted to fire you, he said, would you resign? No.
Yeah.
Do you think the president has the ability to fire you? No. Next question.
Right.
So we can count on status quo for at least the rest of his term. All right, let's go big picture though, Jay, because that's one of your specialties. I'm going to read something to the audience I have here because I just love it. This is Jay. Inflation is caused by excessive monetary growth, but when you cut corporate tax rates, corporate tax rates increase GDP. So in order to cut rates, GDP goes, and marginally it reduces inflation by providing more capital for expansion. And I'm just going to add this for you. We totally reject that crap about Keynesian notions that economic growth is inflationary, because tariffs are at one-time cost or are a one-time cost. It does not increase long-term inflation, and the revenue increases investment, which reduces inflation. So unpack that for us, because I 100% agree, and you and I hardly agree on everything 100%, but this idea that somehow corporate tax cuts are don't help GDP and marginally reduce inflation, people are smoking something wrong.
Well, so we had a lot of disinformation coming out because I guess we've all learned, if we didn't know before the Biden situation, we all know that talking points are actually lies to cover up what the politicians don't want to talk about. So
That's fair.
what happened during the election is that Trump threw out like 300 different proposals or something like that.
Yeah, ish.
But everybody just wants to pick off the tariffs and say, well, if you do that, then the economy will tank and we'll have higher inflation. Well, but he's not going to just do the tariffs. And everybody forgets that it actually marginally boosts US GDP because we produce more here. It's on goods that aren't really essential, don't go into CPI. And so people were actually saying that the Harris platform was less inflationary, which I think is patently ridiculous. They were going to substantially expand the welfare state, the safety net, and increase corporate taxes, lower GDP. So you do have to look the way, and actually this has been discussed. Larry Fink is even on board for this, which is surprising, but his politics are more focused on climate change, not economics. So that the way to get out of the U.S. Budget problem is to grow out of it. You're not going to cut Medicaid, Medicare, and Social Security. You need to have robust GDP growth. To have robust GDP growth, you need savings, but more importantly, investment. Those are equal, by the way. But so you need savings to get investment. And the most direct way is cutting corporate taxes. So the Democratic plan was an unmitigated disaster. We dodged that bullet. But not only did we dodge the bullet, we now almost certainly are going to have a sweep. So we're projecting the corporate tax rate goes to 18, either statutory or effective. In other words,
effective 18.
Increasing tax deductions or credits. And so that bumps up our S&P earnings. We also are going to use a higher multiple because the combination of tax cuts and deregulation. Yeah. And the other thing that's also ridiculous, nobody pays attention to the fact that they want to cut the budget deficit. That's Musk's, spending. That's what Musk is going to focus on. Whether he's successful is a separate issue, but they're trying to do that. They weren't going to do that under a Democratic administration. Oh. So so higher growth rate plus lower taxes, which means higher earnings, gets us to a 7,000 target. And I think what's best about our targets is we don't have a bureaucratic process to raise them. So we raised them at midnight on Tuesday, from 6,600 to 7,000. And that was the right call. Markets.
Did you have a seance or something at 12 o'clock? I mean,
well, yeah, we have a very complicated meeting, but it all occurs within my brain. And then I email it out to our PR firm, and that goes out to the world. And you actually could have read that. If you watch Market Watch, that came out like right around midnight.
Yeah.
And we did it, by the way, before, that was when the odds of Trump winning were about 90%. But, not just on the gambling odds, also the failed New York Times had projected a 90% Trump victory. So that they have a lot of credibility. Even though they're failed, they have a lot of credibility because they're not exactly Trump lovers. But I think it was the North Carolina results really started to show the red wave. And so we can act also before everything, like of course, the networks have to wait for everything to be in, but to call the election, like Fox did pretty early, but the other networks took a lot longer. But we have the flexibility because we're more entrepreneurial to just say, okay, this is a 90% probability. If that happens, our target's 7,000. So that's been the right approach, is to get really long this market, stay long, don't fade every rally. But we're also bullish about bonds, really because of what we already talked about.
Yeah.
Inflation comes from excessive monetary growth, energy price shocks. Both of those are down year over year. We're projecting inflation. Well, actually, if you adjust inflation for shelter, which is distorted, and even Powell acknowledged that today, so I give him credit for that.
Yeah, me too. Finally someone said the hypothetical rent that I could get for my home maybe is a wild ass scientific guess.
Exactly.
And yet it's the biggest component in housing inflation numbers.
Right,
So
it's like 24%.
Yeah.
So that was great that he did that, because the Fed has been pretty incompetent over this cycle. So he acknowledged that. But the other component nobody discusses is auto insurance and auto repair.
Yeah.
Have been like 20% a year, like just hyperinflation nearly. And that's actually just a hangover / legacy of the pandemic. And it's basically been cured. So used auto prices are down, production's caught up. In fact, the auto sector is rolling over, and the Fed should be vigilant about that. So if you also got rid of that auto inflation that's really been tamed, year over year CPI would be basically zero. So it's just two components.
Yeah, I'm with you. I mean, as a side note to what you just said, we're longtime investors in Carvana, which is a platform that sells used vehicles. And we've been tracking used car prices, new car prices, and the spread has been, like that. And you can go to Carvana, have your credit pre-approved, pull in with your car, they then debit your account, and then they complete the financing, and they do it in about 5 minutes. Wow. Or you can have them delivered to your house, and they'll do the same thing. And then to me, that's like the perfect example of, why behavior does not get, or cost reduction behavior does not get priced into the indexes. People are buying used cars. They're buying them from Carvana all over the country. They've lowered their cost, even in a higher interest rate environment, the monthly cost down. Now, auto insurance, don't get me started on that one. I just got a new car, and OMG. But that is...
you always anniversary these things. So that's why, of course, everybody was upset. It wasn't because they're not economists, they're consumers. So they're worried about 2 and 3 year inflation, not 12 months.
Yeah, I'm with you.
So,
well, I mean,
particularly for renters.
All right, we'll go to break here. But net, Jay Hatfield, 7,000 on the S&P 500. And when we get back, I'd like to talk a little bit about, now that bond rates have gone up, why they've gone up. I want to talk about. At some point in time here, though, it almost feels like we would be and in the long-term stuff, we would be at 6 or 7%, yields, and in your stuff with your preferreds at 9 and 10% yields, that's a pretty good alternative to taking risk in the market. So stay tuned. Come on back. We're going to learn how to make money over the next 12 months. This is Money Mavericks. I'm Tobin Smith. Come on back.
You make me sparkle, you make me tingle, even the stars are brighter when I'm with you. And when I surrender to a tasty kiss or two,
Martini and Rossi iced tea.
You make me sparkle, yes,
make the moment sparkle.
Hey, welcome back to Money Mavericks. I'm with Jay Hatfield, a man who is the myth and the legend for being a maverick when it comes to the market, to the inflation rates, to the Fed. So, Maverick one, Jay, for 2025. I know you run hedge funds, you run your preferred fund, you're on Amazon, you have some other stuff. But what are you most excited about to be invested in next year?
Well, we do think that on the fixed income side, that preferreds and high yield will outperform. So you want to be
that's what I was saying before. I mean, the high yield now, I can get high quality high yield and get like an 8% yield with very little volatility versus, what the average market has returned. That seems like a risk reducer, right?
Right. And so preferreds and high yield are very similar asset classes. We actually think that preferreds are better because they're have lower default rates, but they're going to act in this cycle. Taking more risk is better. So the high yield and preferred.
So you prefer preferreds? That's what you're trying to say.
I was trying to avoid saying that, but yes. But I had to stop myself from saying it. But so on the fixed income side, that's where we'd be. We would not be in cash. We think you're, if you're coming out of Fed cycle, like this is, I believe, the best investing environment I've been in since the 90s.
I agree.
So you do not want to be, even though it's tempting to be in a CD getting 5 or 4 that's declining rapidly, you want to deploy into riskier fixed income, or certainly be in tech stocks, but that's kind of like almost everyone is, so it's not a very good recommendation. But we do think that the asset classes that we're involved in, which are dividend stocks, are going to do really well, whether they be small cap or large cap. Probably small cap's a little bit more undervalued. And in particular, what we like in the large cap area and the small cap is investment banks. Now that was a better call. I mean, that was a less
24 hours ago.
Yeah. But we did make the call 24 hours ago.
All right.
It was less obvious 48 hours ago. But now the prospects are, same thing, ridiculously good for these investment banks. They're probably going to set record levels of revenue because you have both. The fixed income business has been all good all year long and will continue to be good. But equities is okay, but not great. It's going to be fabulous when these big AI companies go public, and they're going to go public sooner than you think because it's too tempting, kind of like you were talking about with one of your investments.
Yeah.
It's too tempting to get liquid and take advantage of that. So you're going to see all the companies that did big privates go public, but more importantly, M&A is going to heat up. Absolutely tremendous pent-up demand. It's really why you saw Silicon Valley donating Trump, because they want to get rid of
Linda Khan.
They want her out, and because they have to make money. They have to sell their companies. Like, they're liberals until they have to make money. Until the being liberal precludes them from making money.
Jay, I know you grew up in Silicon Valley as a kid, and I did as well for a part of my life, and that is so correct. I mean, you could be at a cocktail party or an event or a football game, whatever, and it's just liberal, and then you get to the economy, and then the IPO market, and they're like, oh man, I got to support Trump. I think Elon was pretty intriguing. I mean, I've seen there's a difference between kissing the ring and like kissing on the mouth. I mean, he just went crazy, but he has a reason for that madness because of regulations, and he's in such a heavily regulated space that made all the difference.
Well, I think that he was probably liberal too until California started cracking down on Tesla and telling him what to do and unionizing. Yeah. So, in any case, we do think investment banks are a great place to be, but really all dividend stocks, and we have SCAP and ICAP positioned to take advantage of a strong stock market. So we're not all in like Coke, CKO Coke, or like the most conservative, because really want to be a little bit out. We have some of it, to be fair, and that's why you'll see ICAP and SCAP do really well in these type of markets, because we're taking advantage of what's cheap, but also cyclical. So we're coming out of the cycle, even though we really didn't have a recession, we're coming out of a Fed tightening cycle. And so you want to be out on the risk curve on fixed income, as we mentioned, the higher risk bonds, but also investment banks are risky, but they do really, really well when the market's doing well. Yeah.
I mean, the backup, if you look at the list of the top 100 private companies, my investment banking friends, they haven't been in New York for 2 months. They've just been Silicon Valley, Texas, a little Chicago. And the buildup is super there. Now we have your 7,000 S&P 500 coming. And I would argue that, like, again, in our AI tech stack, that's everything from from NVIDIA. We got rid of SMCI, thank God. And, sort of down the stack, all the way down to Marvell Computers, Broadcom, all that stuff. And ANET, by the way, another all-time high today. Well, everybody knows that story. And, just like any other money manager, you start to look, well, what did I miss? What else sort of fits in this theme, but isn't over-owned by everyone or is not overbought at 70 RSI plus. And I think that's what we're seeing now, Jay, is that people they get it. They understand it's a revolution. I would argue that it's really about AI is about agents that actually do shit that you want to get done and not, asking them to make a picture of Jay Hatfield upside down with a cowboy boot. So that's, it just remains to be seen. But like I'm a shareholder in Perplexity through one of the SPVs. I use Perplexity. I can't even say it. Perplexity all day long. I mean, whatever an assistant used to do for me. Sorry. I mean, it answers it quickly. It gives me the charts. It gives me the citing, et cetera, et cetera. That it's certainly going to change financial services, Jay. Don't you agree?
Absolutely. We use a little bit for preparation for our analysis. I mean, we're still HI, but it takes the drudgery out of doing models. I'm told I don't do that. I still go the old-fashioned way. But
I'm shocked, Jay. I am shocked you do it the old-fashioned.
Yeah. But I do my own models too and check our analysts. So
yeah.
But there's one thing that I forgot to mention on the macro side.
Sure.
That is rarely mentioned because we actually have a 350 target on the 10-year. So if that's correct, that's going to really put a tailwind, not just behind your AI stocks, but our income stocks. And that is there's 56 trillion of global pension assets driven by the aging OECD population. Mostly the US, but Europe and Japan. And it's growing at 5.5%. And it's underallocated to bonds. And it's particularly underallocated right now because equities are ripping, bonds are going down, and they rebalance some monthly, some at the end of the quarter. So if you're thinking that, you're looking at a chart and go, oh, wow, the 10-year Treasury is going to go to like 10, remember that there's these contrarian investors who don't care about the chart. Like most of us do care about the chart because we don't like losing money. They don't, because they're like, well, actually, I don't care now. I care about 30 years from now. So just they mechanically, either monthly or quarterly, just say, oh, equities are up, boom, sell them. Bonds are down, buy them. So you're going to see that buying pressure. So you're not just catching a falling knife. There is a catalyst. We do think inflation, the next report might be sort of mediocre, but we're headed to zero. Less oil skyrockets. So that's going to put a tailwind not just behind AI, but also these other stocks. Because that's the easiest way to predict what's going to happen in the market is just look at interest rates. Didn't work over the last couple of days, but just say, okay, interest rates are down. Okay, tech is underperformed. Everything else is going to outperform, including small caps and preferreds. So it's a nice balance to heavy tech portfolios to have some of these income stocks. And then if it stalls out, you get paid 6, 7, 8% a year.
True. Quickly, Russell 2000, do you have comments? Or do you avoid it all?
But with SCAP, what we do is we curate the Russell 2000 and eliminate the 40% of the companies that don't make any money.
You're right.
Because we don't recommend doing that. You're kind of, when you buy money-losing companies, it's like going to a casino and the casino is taking out their percentage. So you're going to lose in the long run because, you're being diluted by the losses. Whereas if you buy profitable companies, you get the value of compounding those companies. And this isn't well understood. Everybody sort of believes like the Kamala Harris scenario that all companies are just expanding their margins forever. They're not.
No. They're price gouging, damn it, Jay. They're price gouging.
Yeah, well, that's price gouging equal expanding your margins.
Oh, okay.
But there's almost no business that can do that. All of our businesses, we have to reinvest in them. So like if a McDonald's, their existing McDonald's usually do a little bit worse every year. So they have to take free cash flow and reinvest. But so that's stacking the odds in your favor. So all they have to do is reinvest pretty well, grow earnings. If you hold the stocks, you make money. So just the simplest rule is only invest in profitable companies. That's what we do in SCAP. It's done extremely well, beating the indices pretty handily and with less volatility. So we think we add the most value really in SCAP by accessing a broad group of companies, getting good income, but avoiding those money losers.
Well, I'm totally with you. Risk-adjusted return, makes sense when you take finance, 301. To the average person, though, risk avoidance is, the market's down, sell. And that's what great management does, I think. And first off, I tell people, like on Monday or Friday, whatever the day that the market crapped the bed, I absolutely tell my clients and my subscribers, do not open your brokerage account. Walk away. And it always works out. We're down on Monday, and if somebody, closed out, I can't take it, they missed all of Tuesday, and, or all of Wednesday, I guess I should say. And you're right that if you have this portfolio put together where you've got a foundation, and to me, sort of AMSA and PFFA are a foundation. We reinvest the dividends, and let's do dividends. Before we go, I do want to ask you one question. Have you looked at doing the call option selling on some of your indexes to generate more income?
So we do that in AMSA and ICAP and SCAP, and it does generate more income, but it's mostly really just alpha because we have mostly cash covered. We're like kind of 90% cash covered or more. But we do like to add that. And then also, if you get capital gains and you get more capital and you can increase the dividend, that's why we're steadily increasing the dividend. So we do love that strategy. It adds alpha and some income depending on where we set the dividend.
For those of you who think he's talking about alpha beta, he's talking about outperformance, alpha as an outperformance. So, all right, Jay, as always, I learned something. I'm a believer. I'm a subscriber. I'm an investor in your funds. Many of my subscribers are going to watch this, and money managers. I never met Jay before. I said, well, he's a little quiet. He has very little opinions, but when he's right, he's very, very right. And my friend, you have been very, very right here. 7,000, baby, I love it. We're now creating a Trump trade. So next time we have you on, I want to hear about what you think about Trump trades, because it's so intriguing to me how the policies aren't even in place yet. But when he got the Senate and the House, to me, it changed the whole picture. And now I can see exactly, what's mostly going to benefit from this. I'm totally with you. Is that the first thing?
It's really profound. It hasn't happened since Reagan swept.
Yeah.
And it's the same sort of changes, the deregulation. It's going to be, of course, there you had a Fed tightening cycle. So it took a couple of years, but
I was there.
The 80s and 90s were just boom times because of that deregulation.
Yeah, I was selling bonds to bond funds to pensions. And I remember being down in New Orleans to the Firefighters Association, those funds, who knows? And these guys are the investment deciders, and they don't know anything about investments. And I just said, listen, you have $75 million of cash in your fund right now. You're going to put $30 million in the 30-year U.S. Treasury bond fund that we have that is yielding 14%. And then in 20 years, you're going to send me a thank you note. Well, funny as heck, about 3 years I was down in New Orleans, and I saw a couple of these guys and says, Toby, you were dead wrong. It went to 140 million. And when you get in a rate cutting cycle, it can be a lot of fun, and you can take less risk and make more money many times in bonds. But I just happen to like your preferred bonds. I just think preferred is, and the high yields are so well covered now that by profits. And when profits go up, their risk goes down, and default, blah, blah, blah. So I'm with you, man. Great to have you on.
It was great. Good fun.
We'll see you soon, big boy. All right, Tobin Smith for Money Mavericks. Come on back and join us next week. We're having fun with this show. See you later.